Inflation has continued to surge in record times, despite the palliatives to cushion its effect on the masses occasioned by fuel subsidy removal and exchange rate unification. According to the National Bureau of Statistics, Nigeria's annual inflation rate rose to 26.72% in September from 25.8% in the previous month, an increase of 0.92 percentage points when compared to the August 2023 headline inflation rate, while food sub-index increased to 30.64% on a year-on-year basis, 7.30 percentage points higher compared to the rate recorded in September 2022. From more in-depth analysis, I'm being joined by a professor of finance and capital markets. Yes, Professor Uche Uwaleke is also the president of the Association of Capital Market Academics of Nigeria. Prof, good afternoon. Thank you for your time.
Thanks so much, Tolu. It's my pleasure indeed.
Prof, 0.92 percentage points is what we see as a shift here from 25.8% to 26.72%. That's what we have for the month of September. I like to always start this way. What were you expecting, and what is responsible for this hike? Many would say it was expected. We'll still have issues with our FX, fuel price, and all of that. But tell us more about this, Prof.
Yes, of course, I expected an increase in inflation rates. There's no doubt that the economy is still reeling from the adverse impact of the removal of fuel subsidy. That is evident in the figures that were released by the MBS. I say it's evident because if you look across the world, inflation rate appears to be moderating. In the US, for example, in the Euro area, in the UK, where inflation rate is expected to come in at 6.5%. In South Africa, even in Ghana, the recent report from Ghana talks about an inflation rate that dropped from a previous high of over 40% to about 38% now. So all over the globe, you would find that inflation rate appears to be tapering. But we find a different scenario in Nigeria, where since January this year, when inflation stood at 21.8%, it's been on the increase, such that as of September, we are getting in an inflation rate of 26.7. So I think it's on the high side. And if you put that side by side with GDP growth rate, the latest we have Q2 of 2023 at 2.5%, thereabouts. That tells you that the economy is in stagflation. What we're actually experiencing now is stagflation, a situation in which you have, rising inflation side by side with, a tepid or a weak, growth rate. 2.5% GDP growth rate is, relatively weak, especially when put side by side with, the growth in the population. Recall that recently the IMF lowered our GDP growth forecast from 3.3% to 2.9%. So the economy is in a stagflation mode, which is very worrisome. And if you look at that MBS report, if you disaggregate that data, it tells you that the pressure point is on food. Food inflation is where the pressure is coming from at over 30%. And that's even on the average. If you take states, the figure for states, you notice that in places like Kogi State, for example, food inflation is close to 40%, over 39%. Of course, the other extreme is places like Borno and Jigawa, where you have maybe relatively lower, much lower, food inflation rate. But the pressure really is on food. Another interesting aspect of that report is that the urban areas are also, feeling it the most. Urban inflation, that's about 29%, okay, compared to rural inflation, which is about, 25%. So urban areas are, feeling it the most. And that may not be unconnected with the, issue of the issues we are facing in the area of transport. So the high cost of transport must have been feeding into what we are getting in the case of urban inflation. Again, that brings me to the 12 items that are reported by the MBS. You notice that food represents about 13.8% of the inflation figure. Inflation figure at 26.7, food is 13.8, so that's over 50%. Okay, you also have electricity, 4%. You have housing, and then you have transport. So these are the major drivers of inflation, in Nigeria. And when I say it's worrisome again because of the, what it portends in the area of poverty. High inflation rate, of course, exacerbates, poverty. Whether you're looking at poverty in terms of, particularly in terms of the multi-dimensions of poverty, the 4 multi-dimensions of poverty, whether it is health, whether it's education, whether it's living standards, or even whether it's work. So inflation is not helping the issue of helping us address the issue of poverty in the country. And there's also another important thing to note. That part of why we're also having this issue with forex, with exchange rate, is also has to do with inflation. Because the more we have a rising inflation in Nigeria, the more people lose faith in the value of our domestic currency, which is the naira. And of course, the more they tend to substitute currency, the more they tend to dollarize, look for dollars. So the demand for dollars is in a way also influenced by the rising exchange rate, which also supports what we know in theory. In theory, that exchange rate is also a function, partly a function of inflation. So if we're able to drive down inflation, it will also help us in our fight to have the naira appreciate in the forex market. And of course, not to talk about the effect it's having on investments. Today, you saw how the market reacted on Monday. On Monday, the Osha index fell, partly in response to that inflation figure. And that tells you that, generally speaking, investments are not, don't find high inflation rates, quite favorable because of inflation has a way of eroding the value of investments, which is why today, for many asset classes, we are experiencing negative real rate of return. When inflation rate is higher than the rate of return, okay, of course, what you're getting is a negative at the end of the day. So inflation is a cankerworm, is a monster that needs to be wrestled down in Nigeria. There's no question about that.
Detailed response there from you, as usual. But staying with food, what moves or what do you think government can do at this time to address some of these challenges with regards to food? Security is one of it, and everyone will talk about that. The farmers need to be able to get to their farm and do their work, So what would you advise government? So if we can address the food aspect to inflation, do you see us coming down, or do you see the figures reducing anytime soon?
Absolutely. Once we're able to deal with the food challenge, inflation figure will come down. Inflation expectation, will also come down because, as we saw earlier, food is the major driver. To address the inflation challenge in this country, there is need to work with data, so such that anything we are doing is evidence-based. And what do we know from data? Okay, MBS is telling us that food, shortages, if you like, are the major issue. So if we know that is where the problem is, then it will make sense to address that. And to address that, both the fiscal authority and the monetary authority must come together. Which is why I think that the issue of inflation in Nigeria, taming inflation in Nigeria, even though people say it's the responsibility of the central bank. Yes, the mandate of the central bank is to maintain price stability, whether in terms of inflation in terms of exchange rate, in terms of interest rates. That is the primary mandate of the central bank. But in this particular instance, given the drivers of inflation, which we've established here, are more of supply side factors, are largely non-monetary, the fiscal authority must also, be involved in addressing the issue of food. You have mentioned the issue of insecurity, which has, been preventing farmers from going to farms, especially in the food belt, regions of this country. You've mentioned the issue of, I can also add the issue of energy costs. All right, part of why we have rising cost of production today in the country is because of the rising cost of energy. So there is need to, if you like, ensure that we have stable electricity, for example. Okay, there's also the need to ensure that we stop importing petroleum products, because the more we import petroleum products, the more we burrow a hole into our forex, and the more you have this demand pressure in the forex market, which is also affecting the exchange rate, which in turn fits into the inflation challenge that we have. So if you can be self-sufficient, attain self-sufficiency in petroleum product refining, it will go a long way to reduce the cost of transportation. I just told you now that at one extreme you have, say, 23% or so food inflation rate in places like Ijigawa and also Loimbono. On the other extreme, you have places where you have food inflation as high as 40% in a place like Kogi, for example. So transport costs, okay, transportation can actually bridge this gap and reduce this, this huge margin. So the best way to tackle inflation, I repeat, is for the two monetary and fiscal authorities to put hands together. It's not only the central bank that will do it. I keep saying it. If you allow the central bank to handle it, central bank only has monetary policy tools at its disposal. Central bank will continue to increase the monetary policy rate in the hope that money supply will drop, okay, and in the hope that inflation will come down. But that's not that will be missing the point. The government also has to come in to address some of these structural issues that will help to bring down inflation, which is why I'm happy today that the two appear to be working together. Today I'm aware that the Presidential Committee on Fiscal Policy and Tax Reforms is working closely with the Central Bank of Nigeria to see how some of these issues would be addressed. So it's not just about this central bank. Again, I would advise the central bank to not to keep hiking monetary policy rates, to, as it were, pause, put an end to monetary policy rate hikes, so that we can lean more on the fiscal side to see how we can bring down inflation. And it's also on that note, I would advise the central bank not to jettison the anchor borrower program of the previous, administration, or the previous management of the central bank. If the program, what the program needs, is actually reform, you review it, reform it to ensure that the original objectives of that program, is attained. It is also the same argument I'm also making with respect to some of the other programs that we have started, before now, which in my view, hold a lot of promise for particularly addressing even the issue of forex supply. One of them is the ROT 200 program. I also think the new CBN management should review it, with a view to strengthening it and to ensure that, again, it's meeting its objectives. So the central bank has a development finance function, which should, in my view, should continue with a lot of, modifications. Anchor borrower program is something I think, no matter what, however we look at it, if it is well implemented, it will go a long way to improve the food, situation we are talking about. So the other
All right, Prof. Let me, Prof. Allow me to interject and ask you a follow-up with that. My first discussion was around the 43 items, and that restriction has been lifted. So if you're talking about the anchor borrower scheme, which if properly implemented, yes, we know, properly implemented would achieve its aim. But what would you say with regards to also that move and what impact will they have on the FX market?
Well, my view on the 43 items, at the time it was introduced, it made a lot of sense. You know, the bank felt there was need to also use some demand management measures to curtail the unbridled demand for forex. Of course, the supply challenge was there. Now the central bank, in its wisdom, has thrown open the doors, readmitting all of them. And the question I ask is the conditions that led to their exclusion from the forex market. Remember, they were not banned, to begin with. Their exclusion from the forex market. Those conditions have they been, met now? All right. So I think, in my view, yes, while one is in support of, liberalizing the forex market, as it were, okay, but that liberalization, should be can only succeed based on a number of conditions. One of which is that you have addressed the issue of forex supply. So as long as the forex supply issue is still there, okay, readmitting these 43 items, in my view, at this time, may not be the right time to do so. So I'm of the opinion that it is not well timed. Okay, we are still having this forex supply issue, because what we have done now is you are now moving them from the parallel market to the official market. So just as some people have argued, the queue now to access forex in the official market will elongate. Okay, the argument that it will eventually collapse or converge the rates between the official and the parallel market rates, okay, that convergence will only be temporary, just in my view, and from what I have, my own assessment, akin to what we saw much earlier. Remember when the government announced the unification of exchange rates, what did we find? What did we see? We saw a convergence. But what has happened now? It has also, started, the gulf has started widening. And that's because the major issue, the fundamental issue, wasn't addressed. And of course, has yet to be addressed. And what's that fundamental issue? The issue of, supply. All right? So until that is done, I am aware that government, is making efforts to address the issue of supply, including through attracting foreign investments. But until that happens, we are still going to have, be having this problem. So admitting all of them in one fell swoop. Again, remember too, the admission was not selective. Okay, it is the entire 43 that has been admitted. So that, in my view, will put more pressure in the official forex market. And I also think that even if tomorrow we find the rates converging, it will eventually begin to widen, because a lot of them will also not be able to access forex in the forex market. One thing is to say, oh yeah, come and access forex. The other thing is, do you have the forex to even give them? Because when they come and they don't find forex, they will also have no choice but to go back to the same, the same parallel market. So reforms are good. That has also been my position. But reforms should be well thought out. Reforms should be planned. Reforms should be phased. Okay, such that we don't keep going back to the same, making the same mistakes. So, what is my position on the 43 items? I think yes. Even if you are going to admit them, it is not now. It is until some of the fundamentals, have been, tidied up. And what are these fundamentals? I keep saying it bears repeating, the issue of, forex supply. The medium to long-term solution to this forex supply is diversifying our export base and ensuring that we have multiple streams of forex. But in the meantime, what we do, okay, I'm happy that if you look at the budget, that 2024 budget, for example, government is now projecting that that it can do 1.79
closing
million
thoughts
barrels
now.
per
We
day,
must wrap up.
1.78 million barrels per day, which is actually our OPEC quota. So if you can do up to 1.78 million barrels per day, and even from crude oil, we have increase in forex. central bank has enough external reserves to even intervene from time to time, of course that will make sense. But until then,
Professor Uche Uwaleke, I must thank you. That's what time can take. Professor of Capital Market and President Association of Capital Market Academics of Nigeria. Thanks for your insight into the topic of discourse. We appreciate you as usual. All right, well, let's